All right, guys, what is going on? What is good? What is good? All right, there we go. Hold on, I lost my music for a second. Okay. Yeah. What up, chat? What's good, everyone? Y'all having a good day? It is Tuesday. Not the cleanest morning that I would have wanted, but no worries. Chat is open today, by the way. Chat is open. Was feeling a little bit generous today. Was good. G, Ebernit, Slowly, Joey, Mark, Da Vinci. New thumbnails look fire. Appreciate you. Appreciate you. Was good. Mark, Roberto, Felix, Julius, H. So, I think the indices are dookie today. I usually don't talk about Dow. I think Dow is usually the worst index to trade. But I do believe that we're on the sell side curve of a potential buy model. So we had lows in here from London. We rallied up at equities open, didn't take that high. So we left behind these clean highs at 550. We did trade lower for those lows, but this is not convincing of a reversal. This is definitely not convincing of a reversal. This trades back into this consolidation. So this looks like bearish until manipulation. That's a vibes analysis for you. Those are the vibes I'm getting. You guys like vibes analysis or what? Who needs technical analysis? Just do what you feel, you know? What's good, Jorgs? What's good, Nikki? Well, if we take a look, right? ES. This looks terrible. This looks awful right here. Look at this. We went from a V to a W to like now just... Y'all ever seen those videos where a cat like sits on the keyboard and it just prints, you know, the letter I or the letter L or something like repeatedly? Like that's what's going on here. It's just V and then another V and then another V. I don't know. I consider this right here, for me, untradeable. Like, this to me is untradeable. NQ is hardly any different. This is almost untradeable. This is terrible. So, what do you do with that? I wouldn't touch it. Wouldn't touch it. Dow is the only one that's like decently... Like, I'm able to frame something that's at least like having a bias versus Chop Nation. You know what I mean? 27,250 was not bad. Like up in here. I don't know. I wasn't up at 845. Late Eagles band. There's a lot of reasons that someone could get banned. That's one of them. Tomorrow the Fed funds rate. You know, I could see that being a thing for sure. But as well, I would expect like the hour or like maybe an hour to 2 hours prior to Fed, I could see being pretty trash. But yeah, this is not fun. This is not fun. One of y'all asked me yesterday about gold, and it did the exact opposite of what I anticipated. And that's why I led yesterday with this is trash. Because I told you we had highs up here, we had some lows in here, and then even Thursday's regular trading hour low down here. And since we were in between the two, it's like, well, you know, I don't know. It could run for the lows and then go for those highs, or the exact opposite. Go for the highs and then go for those lows. So if you were trading Asia last night, that wouldn't have been bad. Those highs taken right there. God, this doesn't really look all that great either. These up candles here that swept those highs that I talked about, we ripped through those up candles here. That imbalance with that gap right there, we trade into that multiple times. And then we launch for those lows. So this is why it's always important. I know I say this all the time, but this is why it's important when I tell you guys, like, when you have levels of liquidity, equal lows, equal highs, low resistant lows, low resistant highs, stuff like that, and you put them on your chart, don't get rid of them. Like, don't get rid of, like, for example, if you took what I said yesterday, okay, he's anticipating the lows and then the highs, and that doesn't happen. It goes for the highs first. Okay, that's insight, because these lows and that Thursday regular trading hour low is still there. If you just assume, oh, well, that was a target that I had and that's been met, so, you know, I don't know what to do with it, you just throw it away and go do something else, that's not good. That liquidity is still going to be there, and that Thursday low is still going to be there. So you see how quick that move was? And again, this was Asia. Like, this is, I hardly ever trade stuff like this, but it just goes to show that the stuff still works, doesn't it? Original consolidation, leave it, back into it, leave it again. Bullish until manipulation. There's your manipulation. A-shaped reversal. What's after the A-shaped reversal? Retracement. There it is right there. After the reversal and the retracement, what comes next? Expansion. Bang. Terminus. Market maker sell model. Is this purple? Yeah, fuck it. Terminus. Oh, that's fine. Market maker sell model. Terminus. So you see how that works? When people ask me, I usually don't get this question anymore, but people sometimes still ask me, oh, does this stuff work in Forex? Does it work in the metals? Does it work, you know, in stocks? It works everywhere. All of them are individually on their own algorithm. And the algorithm for one is going to do the same as for the others. There's minor differences sometimes in like timing wise, okay? But ultimately, they're all going to do the same things. The things that I teach you are universal, especially the market maker models. So if you want, it's not really a bragging moment, but if you remember, I told you about Sudoku recently, and I told you about using the method of deduction. If it's not one thing, it's the other, right? So if I told you, well, I think it could go lower to then go higher, right? Well, if it's going higher instead, then it's not what I told you. So if it's not what I told you, it's going to be the other. Simple. I shorted that Asia Gold AMD and passed that fit top step. Damn, that's some good stuff. I gotta pin that. I got to pin that, big fella. Yeah, a lot of communities have been pretty quiet recently. We're not. No, it's usually not the case over here. Lots of winning over here. Love that. Love that. What questions you guys have? Because I really don't have much else for you. We talked about clear thinking yesterday, which I did clip, by the way. I shortened it, took out most of the cuss words. So I uploaded it. I haven't released it. I'll release it after the stream is over, so that way you guys can have episode 3 for that series. And we'll be doing feedback loops tomorrow on the 29th. Yeah. And then book of the month for May and June. What is it, chat? What is book of the month for next month, for the next 2 months? What do it be? Would the 920 candle 5-minute on NQ be considered a mitigation play? Roberto, it's usually better if you post your own chart so I can see exactly what it is that you're talking about. Right here? You talking about this candle right here? I don't know. This looks pretty garbage to me. If anything, this is a bull flag in here. Usually don't teach you that, but we like to dookie on retail. Is there like a bull flag here? So I could see that. I'm not really sure what you're talking about. Yeah, I don't see that as a mitigation play. I mean, there's an up candle there, sure, but there's up candles over here as well. So I don't think so. I don't see it that way. But yeah, so next month, the next 2 months, dang, 48 laws of power. 48 laws of power. I'm telling y'all, if you have not read this book, you need to. You won't regret it. What do you think about 26,840? Both. I got a lot of tweets on here. Sorry. You know what? We can just me just start over. It's fine. I do like these highs way up here, though. I definitely like those in our regular trade. And you see those on the triple Qs as well, which is usually going to be the case. But that I like those. Said 841, like down here. Those lows right here. We'd have to get through this gap. Which, you know, looks fairly likely because we're at the lower half of this and it's really not doing a lot. And this, you know, now that we have looked at this, this might be the same scenario as Dow. Leave highs, leave consolidation open, and then just stay bearish until manipulation. Something's got to do manipulation somewhere. But I usually wouldn't target something like that. And if anything, I think the one on the right is slightly lower. So probably not. When you watch a 1 minute chart, do you watch the higher time frame indicator candles on, say, a 5 minute and 15 minute higher time frame, or do you even watch the high time frame candles at all? As long as you have, or at least know of those higher time frame levels, whether it be like a gap, an imbalance, or, you know, inversion, or whatever it is, as long as I know that that's there, that's good enough. But I don't always have, I think you're talking about these, right? I think this is daily, it looks like. This is a 15. So you're asking if, when I'm looking at a 1 minute, am I also looking at the 15-minute higher time frame like this? You're asking me if I do this? Not really. Not really. A lot of the times I'm going to flip through the time frames anyway. I'm just used to that. It's not terrible. Or like I've talked about many times in the past, you can just have a triple screen or even a dual screen and just have, you know, 2 time frames up. It's just the difference is with the indicator, you don't have to warp the chart yourself because the indicator is going to be, you know, part of it, which that I like. I like, out of all the indicators that are out there, I mean, there's millions probably, you know, and y'all already know how I feel. Like you know, indicators to me are you don't need those. This is one of the ones that I think is actually pretty decent. But I can't tell you that it's always on my chart. The other most of this stuff is either the watermarks or my session open indicator or like a timing session. I put those on there like years ago. I don't even use them. These 3 are all something like this, just different time frames. And that's it. So other than that, most indicators are worthless to me. You're welcome, Da Vinci. You're welcome. Again, I'm not looking for a opportunity every moment that I'm on the chart. Like what is price going to do right now? I cannot always have a high probability bias every moment of every day. I can't do that. Okay. So now I can maybe have like a guess, or I can lean one way or another. Like in here, for example, with Dow, you know, if I was forced to do something, I'd rather lean bearish than to lean bullish. You know, it would go against a lot of, if this went higher from here, it wouldn't make sense to me, and it wouldn't align with the things that I look for. This to me is not a V-shaped reversal. There's nothing in here to me. Like, look at all this wickage in here. Okay, barcode. Why would I trust that this barcode is going to somehow create the low for then us to go higher? I wouldn't trust that. And then when you actually zoom out a little bit, 5 minute or 15, whatever, and you look at it with a little bit more data, okay, this is our consolidation. As I explained earlier, we left it, went back into it, stayed in like the discount end of it, and now we're trading lower. So this appears like, if this is going to be a model, a buy model, right? Consolidation, leave it, back into it, leave it again. Bearish until manipulation. We have a low right there, 237. We have a low right here, yesterday's low at 190. You know, then that would make sense. Okay, get our manipulation, get our V-shaped reversal, and then so on and so forth and so on and so forth up to those highs. Right? So I'm like basically in my mind taking the buy model and then putting it on here and saying, okay, if this is a buy model, right now we're on the sell side of the curve, and we're gonna, like, this whole thing here, right? That would be the sell side. Once manipulation, then we get our buy side. So as of this moment, it looks like it's sell side delivery. So I can't frame longs personally. I can't. Okay. And it just makes more logical sense to me that this would be bearish more so than bullish. Okay. Now, if I'm wrong and we do go higher from here, then it's no harm to me. I'm not in a trade. Right, Joey. Do you remember what I told you about Microsoft? Do you remember what I told you about that? Here, I'm going to throw up the starting soon screen for just a second. And the problem is I can't remember if that was a download or a screenshot. I don't remember, chat. Give me a second here. This might take me a minute. But there was something specific, if you remember, I talked about for Microsoft, or if I moved it. Okay. Yeah, I can't find it. I will find it for you later. But if you remember, when I pulled up Microsoft, it was the same thing. Back in here, on one of these days, I said if we get back above this gap, back into it to go long. Look what it's doing. We got through it, back into it, stayed in the upper half. Now we're going up again, right? How many people do you know can predict moves? A lot. I know a lot of people that can predict moves. How many can predict multiple moves in advance? Multiple. This, then this, then this. That's at least like 3 things in a row. And we get that. We got through it, back into it. Now we're going up again. And I told you if we did that here, I would look to see that again here. It might have been in the market review, but it was like something like this. We got to get through that gap, back into it, get through this gap, back into it, and then go for those. Right? Now, this obviously is going to take months to pan out. But because that's what makes sense to me. That's how markets work. That's how blue chips work. Like that's what stocks do. Period. Right? And I can't frame shorts here. So we are more likely to go higher than we are to go lower. So that is high probability. And you can know these things in advance. That's why I do them for you. Not a lot of people can. So it's going to be the same thing even on the smaller time frames. It's like you go through your checklist. Didn't we talk about this yesterday on Clear Thinking? One of the ways of like learning how to think clearly is having a checklist, whether it be your trade plan, whether it be market maker models or your entry models, whatever. Or like say what Joey typed in the chat, these short formulas in the way that price moves in order. Expansion, retracement, expansion, or reversal, retracement, expansion. Having that in front of you, when I look at charts, if it doesn't match something like that, then I don't know what is likely. And that's not something that you want to trade. You know? So now once it does, you know, fall in line with that, once it does, okay, take the low or take this low, then get a shift in a steady delivery, then we get that A-shaped reversal and a retracement. Okay, cool. Now I know, all right, the stars are aligning. Now the probabilities are in our favor. Now we can, you know, put risk on. But until that, I can't justify something. Again, like, what would you trade in here? What would you trade in here? Or even in here? That's not going to get you drawdown. That's not going to dance around your entry for a couple of hours. I know a lot of things, but I don't know everything. So I don't know. And if I don't know, then I'm not putting risk on that. You know? What other questions you guys have today? What else you got? Chat's open. We got 52 viewers. I think the chat is open. I think it's been all members today. But I think it's open for everybody. You can ask whatever you want. I don't have any lessons for you today. I guess maybe a little bit of thought process, like what it is that I think about when I'm looking at charts. Maybe that helps you, maybe it doesn't. I don't know. How do you know if an imbalance is valid or not? Okay. Let's go back to gold for a second. It's just the easy example that I know of because we looked at this a little bit earlier. Okay. We'll mark up a few in here. I'll just give you a few examples all at one time. talk about that one. We'll talk about this one. We'll talk about that one. Okay. How do I know if an imbalance is valid or not? So what I used to do a lot of the times, many years ago, was like, okay, let's go over this one first. Say, for example, if I wanted to be bullish, what I used to do was just straight up long at the high end of the imbalance and a stop at the low, or the low of the first candle in this case, right? And now that's not bad. That's not bad. But what tripped me up, and I'm sure this trips up some other people too, is if you take the high end of it, when it comes back to your entry, or even like that drawdown or that second time in drawdown, you might be looking at that and thinking that you're wrong, or that you should cut the trade or whatever. So what you could do instead is treat it like a pizza, and you can cut it in half. And when you cut it in half, yes, I do have videos on market maker models. There are several. What you can do is simply wait for the candle closures. Okay? You can wait for the candle closures. You can always get in on the very next candle. Okay? You don't have to get the low. You don't have to, chase price. You can just wait for the candle to close. And if you see the bodies in here and they're not closing in the bottom half, that's usually a bullish signature, okay? Like this is the bottom half here. Right? Close enough. You get it. It's the bottom half. If the bodies are closing inside the upper half, that's what you want to see in a bullish environment. Okay, that's what makes it valid or not. And it's going to be the same for the inversions as well. Okay, like this is kind of garbage, but if you were to treat that like an imbalance, right, and this goes higher, yeah, like that 720 candle trades into it, off of it, and then immediately lower and rips through it and then closes inside of it. That's not bullish. That's usually not bullish. So then you go, okay, well, that's not bullish. We just took these highs. We have lows down here. So now probabilities are lower. So if probabilities are lower, we want to see this right here. We want to see bullish concepts get disrespected, and we want to see bearish concepts do get respected. Okay? So you can do the same with all of them. Every concept has an inversion, and every concept has a premium and discount. Okay, your mentor didn't teach you that, but I did. Sorry, I love throwing that in there because I gotta talk some shit. But okay, this closes in the bottom half. You don't want that. This closes outside of it. That's cooked. Okay, and then look at this, right? More supply and demand concepts. What's that right there? What's price doing right there? Tapping right into it, closing off of it. This candle can't even get there. That's heavy. That's bearish. So how do I know that this is, valid, like you asked? You can either wait for it to be respected to go long, or you can wait for it to be disrespected to then go short. And then, okay, same thing here. Investigate. Imbalance here, gap on the low end, so we include that. So our midpoint is here. Price can't even get up there. Price can't even get to the upper half. Price is barely getting into the lower half, and the bodies are nowhere near that. That's heavy. So, like, say right here, for example, that candle at 815, you could short that. Because this is hindsight, so we wouldn't know that this would come back into it. So you could short at 815, stop at the high end, aiming for the lows. Okay, like as soon as that next candle opens at 815, that's a short. Or if you wanted to wait like 1 or 2 ticks into it, Okay, whatever. Fine by me. Stop at the high end of this, or, you know, if you're that worried about it, maybe the high end of this candle, right? Then those lows being down here. We have lows here and down here. Those lows here is a 1 to 7. Not bad, not super great. And that lower low is here, 1 to 3.5. That's a lot better. And the Thursday low that I told you about, again, yesterday I told you about that. I said, look at Thursday's low. That could be a downside target, right? 680. We're cutting through that because this isn't supply and demand. We're cutting through that. Aiming for that. That's a 1 to 3.7. That's much better. That's really good. So, in short, no pun intended, to keep it concise, an imbalance is invalid when price closes outside of it. Okay? If you're bullish, you want to see price close in the upper half. It is allowed to close in the lower half and still go higher. It's still allowed to do that. But the point is to keep it as simple as possible. It's based on candle closures. And time as well. Well, you should know that by now. But strictly speaking, candle closures. And you can study that all you like. Please, backtest that. Look at all the candle closures and all your favorite imbalances. Okay? All right. I'm going to do this one more time, and then we are retiring this forever because I'm sick of talking about this shit. ETH is electronic hours. RTH is regular trading hours. And I gave you that for gold yesterday. Okay? This... Okay, that was tripping me out for a second. This is why I gave you Thursday's low yesterday on the stream. Okay, because that had not been traded to already in regular trading hours. It had already done that in electronic on Thursday, Asia, but not in regular. You thought regular was only for indices. You're wrong. That would be wrong. Okay? But those are the differences. So electronic, I believe, is 23 hours a day. Regular is not. So it is an entirely new way of looking at the market that most people don't look at it. Most people have no idea about regular and electronic. And for that reason, they miss easy pools of liquidity. And if you're missing easy pools of liquidity, you're not going to know where the market's going. And if you don't know where the market's going with high probability, you're going to take stupid trades. You take stupid trades, your performance is going to suffer. So that's one of the differences. Electronics can have a lot more information. But when they align, okay, I taught you this too. But I'll do it again since a lot of you are here. Miss Jackson, welcome back. Right? Okay. I want to say this one more time, and I really don't want to repeat this again, but watch this, okay? And if you're not writing this down, don't ever come back to my stream. If you can find, okay? If you can find a pool of liquidity on both electronic side and regular trading hour side, you have a high probability pool of liquidity because it's no longer based on just one, it's two. The more the merrier. Okay? If you never read the Bible before, it says, when two or more are gathered in my name, Jesus' name, I am there. There is power when there is two or more. So we had electronic lows here. We have regular trading hour low at 680. And that 680 is close proximity to those lows. So you have an electronic pool and a regular trading hour pool. And look how okay, don't ever take my word for it. Do not ever, ever, never take my word for it. Look at the chart. Are those rinky-dink miniature down candles? Or are these fat, large, quick and sudden, random supply and demand? All the sellers came in here to sink price down to those lows. That's not casual. That ain't casual Fridays. Okay? That's what it's doing. It's attacking multiple pools of liquidity. Not just electronic, but also regular. And when you have both, that is a high probability scenario. That goes for gold, that goes for silver, that goes for indices, that goes for all of them. Okay? So you learned something new today. If you've never heard that before, if you've never once heard that, now you know. Look at both. Look at electronic, look at regular. If there's a close proximity pool on both, because they're usually not going to be like at the same, like right at the same. But when they're in close proximity, you have a high probability bias. Okay? Can you go over the second leg model again and those two roadmaps you referred to? So when I refer to both, it is MMXM because the X is either buy or sell. There's only two. There's a buy model and there's a sell model. Okay? There's just two. This is the buy model. Original consolidation, distribution, redistribution, manipulation, low risk buy, first leg, here, and then second leg of reaccumulation. In a market maker buy model, redistribution becomes accumulation and distribution becomes reaccumulation. In this sense, a lot of people do think it looks like supply and demand. It's not. Okay? If it was supply and demand, you'd get better entries than me. I know, I gotta stop. That's not the case. Okay? If it was just like this, then a lot of people in the supply and demand realm would do really well. If it's all just supply and demand, if it's all just support and resistance, well then why aren't you running up accounts? Why aren't you doing well? Right, it's not that easy. There has to be a pool of liquidity. There has to be manipulation. There has to be certain signatures. Because that's what the algorithm is coded to do, is this. Okay? So that's the buy model. And it's just the inverse for the other side. Original consolidation, accumulation, reaccumulation, manipulation, A-shaped reversal. Okay? Reaccumulation becomes distribution. Accumulation becomes redistribution for the lows. So does that help you? The second leg model is where you're trading the second stage of distribution, which would be the redistribution. That's why it's distribution and redistribution, not distribution and then distribution. It's redistribution. And I know I didn't spell any of these correctly, but you know, I can't always be perfect for you guys, okay? So that's how that works, okay? Whenever you're trading, whenever I'm like, yeah, it's part of the like let's go back here because we actually still have the markups from yesterday. My mouse does this every time. Original consolidation, not the cleanest one, but it's still a sideways market. Original consolidation. Okay, we left it. We have distribution, redistribution. Now, we had short-term manipulation at 1020. I'm counting this as manipulation, even though it doesn't trade below Sunday's low. And the reason for that is because NQ did. So NQ took Sunday's low, ES did not. So it was short-term manipulation, long-term accumulation. Okay? Yeah, your mentor didn't teach you that either. I know that's why you're here, baby. New shit. Okay? Then we get our shift in a steady delivery. That's the low risk buy. Okay? So after the reversal, after the A-shaped reversal is a retracement. Okay? After the retracement is expansion. Okay? You see this right here? You see this? That low, okay, up to this high here and lower. Now, normally, this would be a, like a mitigation or something. And so since we had a level of distribution, okay, watch this shit. I mean, I gave it to you already, but when we have redistribution and then manipulation, okay, once we get through that and we get back into it, that redistribution becomes accumulation. You see that? Distribution becomes what? Accumulation right there. Down candle here too. You see that? And then we go higher up to terminus. And I think I gave you that high yesterday on the stream. We did a lot yesterday. I can't quite remember. We were going back and forth between the charts and the presentation. But here's the thing. The biggest key when trading the second leg model is after the uh 50%. Okay, so whenever you have highs, whenever we have a manipulation low, whenever we cross 50%, which we do right here at 1110, okay, that 1110 candle here, we go back into a discount. That's its own model right here. This is the fair value model, if you didn't know that. More models that your mentor never taught you. All right, that was the last one. That was the last one. Ego is the enemy. That is the fair value model. But nonetheless, now that we have this, okay, we're at reaccumulation. We've already traded back into a discount. We already got all the stages. Manipulation, low risk buy, first leg. This is now the second leg, and even a little bit after. Okay, even in that final hour. Okay, that's still part of the second leg. So this right here would be like the second leg model, something like that, to go higher. So hopefully that gives you some insight. I also have a video on it, the second leg model. It's a video somewhere. I know there's a lot of videos on this channel. But why do you wait for a price to hit 50% and then pull back and continue? 50% is fair value, which is a discount if the market is bullish. I just showed you that. Or it is bearish in a market that is primed to go lower. It's just one of those it's an algorithmic signature. Okay. There are algorithmic signatures everywhere. Shift in a steady delivery, that's one of them. Inversions, that's another one. 50% in this case, that's another one. Okay. Look at it. Just look at it. Just look at it. Okay. You want to know how I know it's not supply and demand? Look at that body closure here. Look at that body closure. Look at the fucking closure. Where is that closing? Where's the closing? Magically, randomly at that 50% level. That's weird. Why would it do that? Why would it close there? It's pretty fucking weird, isn't it? Oh, that's just random. That's just random. You can believe whatever you want. You're here for free. You're learning from me for free. You can believe whatever you want. But it's an algorithmic signature. Once we have our range, once we have our manipulation and some highs, once we cross 50%, It's usually going to come back in a discount one more time. Sometimes it does give deeper retracements. You got to look at all the price action. You got to see what's there. But once we leave it, now we're definitely part of a second leg of distribution. I mean, excuse me, accumulation. And you notice that the market doesn't give deep retracements, and then it rallies right for those highs. It's not random. Because it is, again, I said this earlier, it is coded to do this. The markets are scripted. Once you learn the script, you know the lines. Just like your favorite movie. So, I know, Jackson, you asked that a while ago. I've been trying to explain all this stuff in detail. With propulsions, I'm not sure what AC means. It starts with one candle and the rest of the sequence be a series, or does it have to be the same throughout? I hope it makes sense. It doesn't. It does not. A propulsion, we actually have one here now that you mentioned it. It's real easy to spot. It's right here. Down candles traded through, being respected to go higher. There's a down candle right there. That's the propulsion model right there. That's an entry technique. That is a series here. God, let me bring my mouse back. That is a series here. So we use the highest up close, right? Notice how that works, that it didn't come down to the last one, only right here. But it didn't come down to the last one here, the highest one. Because I've always told you that. It's the series. It's not the last down candle. It's a series. Now, if you don't have a series, if you just have the one, then that's the one. That's Neo. The one. See that? This is all the matrix, dude. That's all this is. This is a very, very structured, highly curated market. This is a highly controlled market. And this can't be hidden. Once you've been exposed to the information, once you see it, you can't unsee it. Unless you just deny it. You can deny it all you like. Good luck taking drawdown. Good luck having a shit win rate. Hey, if it works, it works, but it's your career, it ain't mine. Right, Joey, that's the law of the return. What was once bullish becomes bearish, or what was once bearish becomes bullish. That's what it's based off of, market maker models. You can almost do anything you want to, as long as you're trading within a market maker model. You could long below old lows, although you are basically saying, hey, I think this is going to be the low. Or you could trade right after it. That's the NCE, the next candle entry. Mentor probably didn't teach you that either. Okay, I lied earlier. That's my last one. Every concept has an NCE to it. You can wait for it to be respected, trade the next candle. Okay, imbalances, same thing. Let's go back to gold for a second. I think I told you that earlier. Wait for the candle closures, trade the next candle. Wait for the candle closures, trade the next candle. Oh, look at that shit. I didn't even see that earlier. What's that right there? What's that right here? 850, 910. That's when we get our move. We get our expansion move during time windows that don't exist, right? This shit doesn't exist. Macros don't exist. Come on. Again, you can deny it all you want to. You can say it exists all you want to, but now you're just in denial because you see it in price. You see it in price all the time, all the time. And you choosing to ignore it is quite literally autistic. Like, you're autistic. Like, you're retarded. IQ of a fucking rock, honestly. To look at reality and deny it. That's crazy to me. Literally, that's insane. You love that fair value model? It's a good model. The lazy traders model and the fair value model both operate outside the scope of time and price because it's logic based. It is, let's go back to Yes, sorry. Okay. The lazy traders model and the fair value model are both outside the scope of time and price. So now all you have is context, right? You're eliminating time, you're eliminating price. Now all you have left is context. I know. It's crazy stuff. But unlike most people, I'm not limited to just trading one way. And neither are you. Whenever the market makes a low and then crosses 25%, as soon as it comes back to it, that's a long. That is the lazy traders model, because quite literally it is lazy. Think about it. It's not based on time. It's not based on price. It's only based on a fib. I mean, I guess that is technically price, but there's no, what I mean by price is there's no concept tied to it. And you're straight up longing 25%. Okay? With a stop at the low and aiming for the highs, which is always and never won't be this way, a perfect 1 to 3. Perfect. Every time. That is the lazy traders model. The fair value model is the same, except the only difference is you wait for 50% to cross. Now you're longing 50%, stop at 25. And instead of a 1 to 3, it's the same target, which is now a 1 to 2. So it doesn't have as good of a RR. You're watering down the RR a little bit, but it is higher probability because we've already crossed 50%. And yeah, if you do trade the fair value model, I promise you, there are times where you will take drawdown, because it might want to trade for something lower, like an imbalance or maybe a low, and maybe sweep the low, and you might have to sit through that drawdown. So, and it's not going to be like a sniper model per se, but it's still a model. And those are two models that you can utilize everywhere. Everywhere. Because again, and don't miss this, you can have as many models as you like, as long as they are within a framework, as long as you know where the market's going and where it's not likely to go. Everything in here is high probability. Everything is high probability. 25%, high probability. Shift and stay delivery, high probability. Propulsion, high probability. Inversion, high probability. It's right there. Trades right here. This imbalance right here, trades through it, back into it. That's its own model. 50%, that's its own model. That down candle there, that's its own model. You can add another 5 or 6 models, because you could take every model here, wait for the candle closure, and then just trade the next available candle. That's models on models. It's like a Victoria's Secret fashion show over here. Okay? It's not bad, right? It's not bad at all. Love that. Let's go back to gold for a second, and then I'll shut it down for today. Okay? It's the same thing here. If we take everything off, okay? Watch this. It's just the logic. Those are the lows that I told you about. These are the highs that I told you about. That was the manipulation first. Okay. So let's see if the model works. We trade below 25%, back into it here. So this candle trades outside of it and then closes. I might have waited for something like that. This candle closes below 25. 740 trades right above it. Okay, that's the short then. That's the short at 25%. Stop at the high, aiming for the perfect 1 to 3. That was roughly right there. Sometimes the RR tool isn't going to be, you know, right at the level, I guess. You get the gist of it, though. You get the picture. Okay? Look at that. 50% here. We cross it. Immediately back above it. So let's assume that the entry was crappy. Let's assume that the entry was trash. If that stop was at 25, yeah, that looks like it's going to get stopped out. But you have that imbalance up here, remember? Oh, not bad. Perfect 1 to 2 is still... Well, the 1 to 2 is actually here. But aiming for the same lows is right there, which actually you get a little bit better than a 1 to 2. So, yeah. You can trade a model outside the scope of time and price. Who taught you that besides me? I don't know. Not many. I'll close it with this. At the end of the day, chat, at the end of the day, as long as you're working within a framework, okay? Meaning market maker models, okay? It ain't Wyckoff. And I'm not trying to start no shit today. I'm not trying to piss anybody off. It's not Wyckoff. Okay? It's not. They do look similar. I can agree to that. I can agree to that. They do look similar. But there's a lot of details that you're going to see with market maker models, quite frankly, you don't see in school of thought that's fucking 100 years old. It's just not there. Okay? It's not to be disrespectful. It's just, that's the truth. It's not there. There are things here that you will see that are not over there. Okay? With all due respect. It is what it is. So, as long as you know what the models are and what they're likely to do, you align with that. And when you align with that, you're going to take really, really good trades. And your win rate will be higher than 50%. Okay? And you will feel a lot better as a trader when you can, let's say, win 6 out of 10 trades or 7 out of 10 trades. It is possible. You might not think it is, but it is. And if you simply follow the framework and you get it correct, yes, you will have a much better win rate and you'll have a much easier time trading. So, with that, y'all be good, be blessed. We'll be here same time, same place tomorrow for feedback loops. All right. We'll go over feedback loops tomorrow, which it's not going to be the funnest presentation. You know, there's really not like charts involved, but it still is a very important lesson that a lot of people still ignore. Yeah, J-Rock, I don't really follow him. Not to be mean, but he sounds like ChatGPT. So I don't follow people who use AI to mentor. You're not a mentor. If I wanted to be mentored by AI, I would just do it myself. So I'm good. I'm good. So, all right, I'll see y'all tomorrow.